Hello guys, welcome back to my YouTube channel. Today's video is going to be a powerful educational breakdown about one of the most important concept in trading, liquidity in forex and crypto markets. Many traders believe the market is specifically targeting their stop losses, but the reality is different. The market does not hunt individual traders, it moves toward liquidity because that is where orders exist. Before we begin, a quick disclaimer for all my viewers. This video is created for educational purpose only. It does not provide financial advice. Trading forex and cryptocurrency involves significant risk, and everyone should always do their own research and risk management before making any financial decision. Now let's break this topic down step by step in a clear and professional way. So the first important point is understanding what liquidity really means. Viewers, liquidity simply means how easily buy and sell orders can be executed in the market without causing large price movements. Financial markets operate by matching orders. For every buyer, there must be a seller. Price moves when there is an imbalance between buyer and sellers. When a market has high liquidity, several things happen. Spreads remain tight, orders execute smoothly, price movements appear stable and controlled. When a market has low liquidity, the environment changes, spreads become wider, slippage becomes more common, price spikes and long wicks appear on charts. In the forex market, liquidity usually reaches its highest level during the London and New York session overlap, where major financial institutions are most active. In the cryptocurrency market, liquidity depends heavily on the exchange volume and the popularity of trading pair being traded. And the next important point is where liquidity exists on trading charts. Viewers, liquidity does not appear randomly on charts. It tends to accumulate in very specific locations. Common liquidity zones include above equal highs, below equal lows, around obvious support and resistance levels, near trend line touches, around breakout zones, near clusters of retail traders stop losses. Retail traders often place stop losses in predictable areas. For example, buy trades usually place stops just below recent lows, and sell trades often place stop just above recent highs. When many traders place stops in the same location, those stops create what is called a liquidity pool. Large market participants, such as institutions or major traders, often require these liquidity pools in order to execute very large positions without disrupting price too aggressively. And the next important point is how a liquidity sweep happens. Now let's walk through a common scenario that happens in both forex and crypto markets. First, price forms equal highs on a chart, and many traders notice this resistance level and begin placing sell trades. At the same time, the place stop losses just above those highs. Next, price suddenly pushes slightly above the highs. When this happens, those stop losses get triggered. A stop loss becomes a market order when it is activated. Then price reserves and begin moving downward. This event is called liquidity sweep. It is not personal, it is simply how order flow and market mechanics function. Now the next important point is liquidity differences between forex and crypto. Viewers, although the concept of liquidity exists in both markets, there are some important differences. In the forex market, liquidity is extremely deep. The market structure involves large banks and institutions. Central banks also participate. Price movement usually appears smoother. And in the cryptocurrency market, liquidity depends on exchanges. Some markets are heavily influenced by large holders, often called whales. Altcoins may have thinner liquidity. Price movements can produce aggressive spikes and long wicks. Because of these differences, liquidity sweeps in crypto can appear much faster and more dramatic compared to forex. Now we will discuss real chart example explanation. Let's imagine a real chart example. On a 1 hour chart, price forms equal high several times. Traders see this as a strong resistance level. Eventually, price breaks slightly above those highs. Many stop losses are triggered instantly, but instead of continuing upward, the market quickly reverses. After the liquidity sweep occurs, the structure of the market changes and price begins moving downward. Another example happens during high impact economic news events. When major news is released, liquidity changes rapidly and spreads may widen. Stop losses get triggered quickly. Volatility increases sharply. This is why news events often produce sudden spike on charts. Now the important point is how professional traders adopt. Viewers, this point is very important. Professional traders adjust their strategy once they understand how liquidity works. Instead of placing stop losses exactly where everyone else does, they think differently. They may use deeper structural invalidation levels and wait for the liquidity to be swept fast, enter trades only after confirmation appears, pay close attention to session timing, avoid trading during periods of extremely low liquidity. Experienced traders often follow a structured process: liquidity, structure, confirmation, and execution. Now we will discuss the psychological shift. Viewers, one of the biggest changes happens in a trader's mindset. Once you understand liquidity, several emotional reactions begin to disappear. You stop believing the market is personally targeting you. You stop moving your stop loss out of frustration. You stop chasing every breakout you see. Instead, you begin observing the market patiently and waiting for liquidity to be taken before making decisions. That shift alone can significantly improve discipline and consistency. Viewers, so the next time you see price spike above a high or below a low before reversing, remember this: the market is not moving randomly, it is moving toward liquidity. Understanding this concept can completely change the way you read charts and interpret price behavior. Thank you for watching this educational breakdown here on my YouTube channel. If you found this explanation helpful, don't forget to like this video and share it with others who are learning about trading. And I will see you in the next video with another professional breakdown of market structure and trading psychology.